Would you ever buy this asset? I'm certain you own some. Or would you ever buy this? You probably own this as well. Or would you buy this asset over here? Maybe you own this. None of those charts were US dollar denominated charts. They were charts that looked at opportunity costs. There were charts that took out relative valuation. And when we look at relative valuations and we look at correlation, then we can potentially get an idea of what the ideal portfolio should look like. Now, first of all, what is this? This is a chart of the S&P 500, but a chart that you normally don't see plotted this way. It's 1 over the S&P 500. It's the inverse of the S&P 500, and it went down by 99.9%. This graph shows us the value of a dollar relative to the S&P 500, or what is the opportunity cost of not investing your money over the long term. You destroy everything. This chart is the reason to get into stocks, get into investments, and to not just have your cash somewhere laying under the couch. This is actually rather a flattering chart because it's plotted on a logarithmic scale. Here's the same chart plotted on a linear scale, right? Your purchasing power is pretty much zero. You can't hold cash over the decades. Now, this isn't really news, but some follow-up charts might be news to you. This chart, for example, what we're looking at here is the value of long-term government bonds relative to the S&P 500. So had you invested into long-term government bonds instead of the S&P 500, you had lost 80% in the last 15 years. Or you'd have 5 times more money had you bought the S&P 500 instead of long-term government bonds. Now, where does this long-term underperformance come from? It comes mainly from rising interest rates because there's an inverse correlation. When interest rates go up, then long-term government bond prices go down and vice versa. In other words, if you believe that interest rates are going to come down in the next year or two, buying long-term government bonds might make sense. Because again, when the interest rates go down, you have to discount future cash flows less. Thus, because there's less discounting, the price of the asset should go up. Will they recover back to their glory after interest rates are at zero? Probably not, but we might see a bit of a rally again. Still, so far what we're seeing is that what the textbook is saying is true. If you take on zero risk, as in you just hold cash, you tend to do very, very poorly. If you take on a little bit of risk by buying stocks, you tend to do better. If you take on less risks compared to stocks, so you buy long-term government bonds instead of stocks, then you again tend to do worse. So the more risk you take, the more return long-term you should be getting. This is pretty much what everybody believes anyway. Does this theory hold when we look at riskier investments? Riskier than just the S&P 500? Let's have a look. What we've got over here is the S&P 500 relative to the NASDAQ 100. So all of US economy relative to just the tech sector. And the tech sector is seen as the more risky, right? The growth sector that should on average outperform. You take on more risk, you should get more return over the long term. And this is actually what we are seeing. The S&P 500 underperformed the NASDAQ 100 by roughly 80% over the last 40 years. Why do we see this massive crash here and then the recovery? Where does this come from? This is the dot-com boom, right? So the NASDAQ 100 outperformed the S&P 500 during the dot-com boom. Then the bubble popped and then we got back onto our long-term trend. So holding cash is terrible. Holding stocks is better. Holding technology stocks seems to be even better. But we can go up further the risk curve, right? This is the Bitcoin strategy channel. So let's have a look at Bitcoin. And here is the chart. Do you actually want to hold tech stocks? Because this is how tech stocks performed relative to Bitcoin. An underperformance of a rounding error of minus 100%. Bitcoin absolutely blew it away. And yes, that outperformance tends to shrink now that Bitcoin is already quite large. Still, the higher we go up the risk curve, the more we should be expecting long-term. And of course, there is a bit of a survivorship bias here, right? If you go up even further the risk curve and you look at meme coins, etc., you can find meme coins that outperform Bitcoin, but you can also find a lot of meme coins that don't outperform Bitcoin. Now, does this mean that we should simply just hold purely Bitcoin and nothing else? Does it mean that we should stay away from stocks or that we should stay away from government bonds? The answer is probably no. But why is it no? It's because of correlation. It's because when one asset is crashing, the other asset does not necessarily have to crash. And this gives us two advantages. The first advantage is that we can potentially buy the bottom, right? When only Bitcoin crashes, but your Nasdaq 100 ETF didn't crash, you can sell some of the Nasdaq 100 ETF and buy Bitcoin cheap. So you can take some opportunity by being diversified. The second advantage is, of course, that your overall portfolio volatility isn't moving that much, right? When Bitcoin crashes 70%, then your wealth doesn't crash by 70% when you own all kinds of assets. But that means when we buy something that has less expected return, that at least for compensation, we want to see low correlation to the thing that performs the best. It does not make sense to buy an asset that is highly correlated with the asset that performs massively. It does not make sense to buy an asset that performs less on average that's also highly correlated. So we are okay with less performance as long as the correlation is low. We are not okay with less performance if the correlation is high. And let me show you what I mean in data. Check this out. This is the S&P 500 again. And what we see here at the bottom, that's the correlation coefficient to the Nasdaq 100. It tends to be pretty high, right? It tends to never fall below 0. It tends to be between 0.5 and 1 most of the time. In other words, when you own the S&P 500 and you own the Nasdaq 100, those two assets are likely going to move up and down at the same time. In other words, the Nasdaq 100 is crashing, then your S&P 500 index is likely going to go down as well. And I know this might be a controversial take, but because of that, because general stocks tend to underperform growth stocks, and because general stocks are highly correlated to growth stocks, I don't think it makes sense to own the S&P 500. I do not believe it makes sense to own SPX ETFs. You want to diversify with something that has low correlation. You only want to give up expected return correlation to your other asset is low. And so have a look at this. This is the Nasdaq 100. And what we see here at the bottom is the correlation coefficient to Bitcoin. Isn't that interesting? The correlation coefficient to Bitcoin goes to -1 sometimes, right? It's way more erratic. It's way less clear compared to the correlation coefficient of the S&P 500 to the Nasdaq 100, right? The S&P 500 goes with the Nasdaq 100 all the time, but the Nasdaq 100 does not go with Bitcoin all the time, contrary to popular belief. Popular belief is that Bitcoin is just a levered play on technology stocks. It's not true, right? The data tells us that the correlation coefficient is relatively low. In other words, it makes a lot of sense to own both Bitcoin and Nasdaq 100 ETFs. The correlation is low. It's okay to not just own Bitcoin. Bitcoin might outperform the Nasdaq 100, but it's okay to also own some Nasdaq 100 ETFs because the Nasdaq might not crash when Bitcoin crashed. And again, we see this in the numbers, right? This is the correlation coefficient. It looks so different, right? Stocks are highly correlated to one another, but the Nasdaq 100 is not highly correlated with Bitcoin. Now, does it make sense to own long-term government bonds given that they have underperformed the S&P 500 that much? I believe parts, at least, of the underperformance is due to the increased interest rate. So if you're expecting the interest rates to go down, it might make sense to buy. But also the second reason to buy long-term government bonds despite the past underperformance is again correlation. This is the correlation coefficient between long-term government bonds and Bitcoin. And again, this is moving very erratic up and down. So we've got a very nice portfolio diversifier. So that's truly what I believe is the best setup for a liquid portfolio. It's long-term government bonds, it's Nasdaq 100 ETFs, and it's Bitcoin. And the weighting of those three assets obviously depends on your risk tolerance. It also depends on where you currently see the market going, right? If you currently believe that long-term government bonds are cheap, then buy those, then overweigh those. If you currently believe that Bitcoin is super cheap, then overweigh those, right? But always be aware there is obviously risk in any investment. But by owning more than just one asset class, by being diversified across different asset classes, we can at least cancel out some of the risk mathematically. Why own S&P 500 ETFs if there are also NASDAQ 100 ETFs? Those NASDAQ 100 ETFs tend to outperform and they tend to move up and down on the same day compared to just the S&P 500. Why own the S&P 500? It does not make sense to me. Owning something else besides Bitcoin does make sense to me, again, because we want to take advantage of price drops in case we see those massive crashes. We sometimes do see them. So if Bitcoin goes down 50%, do you actually have enough capital to deploy to take advantage of that dip? If you don't, then maybe instead of holding cash that really gets crushed in value, maybe have some NASDAQ ETFs and some long-term government bonds. A mix out of both, potentially. If you found this useful, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. In case you've got Telegram, then feel more than welcome to join us. The link is down below. Looking very much forward to chatting with you. Feel free to also check out Premium. This is where I share what kind of trades I personally do.